wealth is more than money. It's legacy, wisdom, and the alignment of purpose. Welcome to Crown and Keys, where we unlock the secrets to generational wealth, passive income, and financial freedom through real estate, tax strategy, and personal development. I'm your host, Cynthia Spirlin, your guide on this journey. With over 20 years in real estate investing, a Juris Doctorate, and the passion for aligning wealth with purpose, I bring you conversations with the most brilliant minds in real estate, finance, and entrepreneurship. Together, we'll uncover the strategies that turn income into impact and assets into legacy. Your wealth isn't just for you, it's for the generations that follow. So grab your keys, adjust your crown, and let's build something that lasts. Hello, and welcome to our edition of Crown and Keys. In this episode, I'm so happy to welcome Alan Mack in beautiful, sunny Southern California. He's a very highly experienced advisor in mortgage and real estate financing. And I want to introduce you to Alan and his world and how to create generational wealth through the right mindset as well as the right tools that and strategies that he brings to his clients, and has created the most amazing career. We're going to learn about his career and how he has turned that into opportunities for his clients and to build a great business for himself. So welcome, Alan.
Welcome. Thank you for having me on your podcast today. Great to be here.
Oh, great, great, great. So let's dive right in. Let's not have any suspense. Tell us about your illustrious career in banking.
Sure. So, I got in the mortgage industry 37 years ago. So, it's been a great career for me. I decided back in March of 2020, I left the banking world and I formed my own corporation. And what I decided I wanted to do was really work for the client as an advisor, kind of like that concierge service in the luxury market. And what I bring to that client is one, the best rates they're going to find in the nation. The banks all work for me. I have, decades in banking, and so I work for the big banks, Citibank, Bank of America, Wells Fargo as an executive. So it's kind of like the inner circle. We kind of all know each other, the top producers with the different banks. And so what I've done is I've created a program where I work for that client and I talk to them about their situation, what they're looking to buy. And my goal for them is not only get the best rate possibly for them, but also structure it in a way where it really creates more cash flow for them, where they can invest in other properties or other type of investments they want to, where they want to put their money instead of putting it all in four walls. So if you think about, if you're going to buy a property, say a $3 million home, and you want to put 50% down, let's say $1.5 million down, you're putting all your money in that house in the four walls. You
Right.
can't reinvest that. So
Yeah.
what I've done is I've created this service and really helped them out to create more cash flow for themselves.
Well, can you give us example of what that would look like? Because my daughter is house hunting, and we've been vacillating. Well, I've been helping her to be more open to not seeing a home as the single family dwelling, but like her first investment to do like a duplex at the minimum, maybe a fourplex, so that she can have the same budget, but get more where she can have passive income supporting her property.
Yeah, that's a great idea. If you're going to buy a multi-unit and call it 1 to 4 units, that falls in the residential realm. When you go over 4 units, 5 units and above, multifamily, that falls under commercial. So it's a whole different process as far as underwriting, things like that. But,
Yeah.
buying a property, if you can turn around and get someone else to help pay off that mortgage for you, right?
Yeah.
Where you live in 1 unit and you rent out the other unit, or maybe 2 units or 3 other units, it's an opportunity to create some cash flow for yourself. And, a lot of wealth is built in real estate, and let's be
Right.
honest. I mean, it's the biggest transaction anyone will ever make in their lifetime. And we've seen appreciation if you go back 20 years, 30 years, 40 years in real estate. I mean,
Hmm.
quite a bit of appreciation. In fact, since COVID in 2020, we've seen 50+% appreciation since that time period, which is amazing to think about. So, I think one of the issues and challenges today for many young ones or first-time home buyers is affordability. And that's
Yeah.
the thing right now is it's really getting those interest rates low enough where they can afford it. If you think back in 2020, 21, and the beginning of 22, rates were 3 to 4%. I mean, it's a lot easier to qualify to buy a home. But if you live in a market like mine here in Southern California, the median home price is 1.1 million. It becomes very difficult when you think about, not only your mortgage payment, your property taxes, and then your homeowner's insurance to boot, and then you've got
True.
association dues in many instances too. So,
Yeah.
affordability can be an issue, but it's a great investment. I mean, real estate appreciates, and if you're going to get in and buy a home and you want to get in and get out. Well, you're taking a risk there. There are flippers where they'll go in and they have some investment behind them and they'll buy a property, fix it up, and then flip it to resell and so forth. But, if the market turns in any way, you can get caught. And that's what we saw back in 2008 when the whole market collapsed on us. And I don't think we're going to see those times again. But go
Yeah.
back in 2008, there were people that were investing in real estate. And unfortunately, the market collapsed. There were many people that really were in trouble. So, but looking at real estate overall, it's a great investment. It's something to hang on to. It is real property. It's not like you're investing in a stock and going up and down, and someone else is in control of that stock and how it does. When you buy real estate, it's yours. You own it. You can do whatever you want with it. You can fix it up and so forth. So keep it as long as you want, or if you decide you want to sell and buy something else, that opportunity is always there. But again, I've seen more wealth built in real estate than any other investment.
Have you worked with a 1031 exchange where someone was buying and exchanging it to another property? Have you worked with any clients with that
Yeah.
scenario?
Yes, I have. So, again, at Turn 31 exchanges, they have an investment property, they want to sell it, and if they sell it and take those profits, they got to pay capital gains on that. So, a way to get around capital gains is do the 1031 exchange, where they can buy a like property and basically roll their money right over without paying any type of capital gains. So, yeah, I've seen quite a bit of that throughout the years.
Okay. And so, like you were talking about a scenario with the $3 million property. So, how would you work with someone that had a budget of $3 million to make the most of that capital?
Well, the great question. So what I do is with the clients, and again, I work in the luxury market with affluent clientele, is I'll spend about 10 minutes to 30 minutes on the phone with them, really going through their portfolio. So what I'll do is I'll start off with their income, and most of them are self-employed. They'll own a company or two or three or more, and
Mm.
I'll go through that as far as their cash flow and so forth. And then I'll get into their assets, where their assets are at, liquid and non-liquid, non-liquid being retirement type of accounts, and then I'll get into their credit situation. I'll say, what's your overall goal? Is it to really maximize your cash flow, as many individuals in the high net worth market like to increase their cash flow? And
Yeah.
that's typically the case. So what I'll do is I'll figure out what their whole scenario is, and from there, I'll know which bank to take them to. So, unfortunately, the three big banks out there, they get about 75% market share. It's Bank of America, Wells Fargo, Chase, but they're not always the best bank for that client. It's the most convenient because they're everywhere. But the issue is these banks are a little more conservative sometimes. And so, there
Oh,
are other banks out there. There are hundreds and hundreds of banks that want to compete for that business. They'll have programs, they'll have different guidelines, they'll have pricing exceptions. I got a bank right now, I'm getting rates in the
wow.
fours, when rates
Wow.
are around 6%, 6.5% right now. So
Yeah.
again, I know where to go. It's like taking that client to the right bank. And so every client is different, every client is unique. It isn't like if you think of a conforming loan, which is in the 800,000 price range, loan amount, excuse me, right on that price range. I don't do those.
Mm.
It's a loan that can be done through any bank, any lender, and so
Okay.
forth. It's
Okay.
sold to Fannie Mae or Freddie Mac, so they all underwrite to those guidelines for that particular buyer. So
Oh,
it doesn't matter where they're going for that financing, other than the rate, so to speak, but it's the same guidelines. In the non-agency, or we call it the jumbo, super jumbo world, those are portfolio loans. Those are banks that portfolio those. They put them on their own books. It's their money. So their
mm.
guidelines can change daily. Their
Okay.
pricing can change daily. They're in and out of the market all the time. It depends how much they've got to lend out. And so
Mhm.
I know those banks. I talk to those bankers every day, so I know which bank to go to get that best product for that particular client.
Oh, I see. I see. So that's really what's the key thing is. So these loans are a million plus.
Correct. Yeah, it's typically about $1 million plus if you think of it that way to make it real simple. So,
Hmm.
and again, I can get financing up to $100 million loan amounts and plus. So there are a few banks that will go up that high. And again, they're all different. They're unique. I've got one bank in particular right now that, of course, all my banks are nationwide. That's the first thing. But they offer a 2-1 buy down, which you don't see in the banking world. You see it in Fannie Mae, Freddie Mac, with higher rates, we're able to get what's called a 2-1 buy now, where that seller can offer a concession to that buyer, and I can get a rate right now in the high threes right now, the high
Wow.
threes.
You're not
So it's
hearing, no one's talking about numbers like three
no,
and four
no,
percent.
high
No
threes,
way.
primary and second home. So it's, there's some really neat stuff out there from these banks, but the problem is with the banking world is they can't advertise their products. I work for those banks, and
Mm,
trust me, when I tell you, you have to be as generic as possible when you do any type of marketing, advertising through social media. They're all
yeah,
about protecting their brand name. And I
yeah,
get that, I understand that. So for me, because I don't work for the banks, I work for the client, I'm
yeah.
able to advertise these different products and programs these banks have to help that consumer.
Oh, I think that's awesome. But you're rare. I mean, how does someone find, someone like you?
Well, I do what I can to market. My company is growing. In the last 2 years, I've done over $100 million in closed contracts the last two
Wow.
years in a bad market, and I'll probably do 100 million this year alone. But what I do is I'll market through social media, LinkedIn, Facebook, Instagram, some
Okay.
other means of advertising and so forth to get my name out there and get what I do out there. I've had
Yeah.
the privilege to, for the last 5 years, I've been in Forbes magazine and Fortune magazine. I'm on the
Oh,
newsstand, I think now in February, March issue. I made Fortune again this year. So I've had the privilege of
congratulations.
having, thank you, having a great reputation. I pride myself on customer service. I'm all about literally giving that concierge service in the luxury market. So 9 times out of 10, you call me, I will pick up my phone. I'm always available for that client 7 days a week, holidays included. I'm all about service. And that's really what it comes down to is that, the problem in the banking world, unfortunately, and kind of so you understand this, is the banks hire many instances very inexperienced individuals that want to get into finance. Usually someone
Okay.
that gets out of college, young, and so forth, and they'll pay them a salary, a little basis point override or bonus, and so forth. But the problem is they're not experienced enough when you deal in the luxury market where you've got very
Mhm.
complicated tax returns, complicated borrowers, and that's where it takes the banker that really knows what they're doing. So my bankers, for all the banks I work with and credit unions and investment companies, they have anywhere between 20 to 30, 40 years of experience.
Oh,
They're the
wow.
biggest producers in the United States in these banks. They have
Yeah.
their own teams, own underwriting staff, and so forth. So literally for me is I go in a different door of that bank because I have those relationships with those banks. So I take you right to the top of the house, and the service, like I said, is there's nothing like it.
Well, it sounds like it's very custom. It's not a one size fits all. And more with the way the economy is changing, where it's entrepreneurial and business people, that are able to afford a home now, they need to have this customized. A one size fits all generic loans won't work. So I think that it's really important for someone that's conscious of creating generational wealth and wanting to keep more of what they earn, they have to be really cautious when they're making a big investment like a home and having a 3% rate versus a 7% rate. That is, I mean, imagine the savings and what you're able to do with that money, invest in other things. You could buy a
Well,
whole
and
nother
that,
property.
yeah, and not only that, but if you think of when someone wants to buy a property, right, is that you have cutoffs. So let's say you buy a property up to 1 million, it's a certain type of home. When you get over the million, maybe to 1.5 million, it's a different type of home, and then you get 1.5 million to three. So as you climb, as far as the price, as far as it goes up, it's like
Yeah,
buying a car, same thing, right? You can buy a
yeah,
$20,000 car, you buy a $100,000 car, and
right.
so of course when these rates come down. If you go from a 7% rate to a 3% rate, I mean, that payment's more than cut in half, right?
Hmm,
So
hmm.
you create some affordability. And, I know when the rates were, back in the threes, I was seeing, like $1 million loan, the payment was like $3,200 a month. Today,
Yeah.
if you get a 7% rate, it's probably getting you like a four or $500,000 loan, and so it buys you a lot more home,
A lot
so as
more.
the as this new administration is working on bringing down these interest rates, and I think they will. We're seeing the 10-year Treasury has been coming down over the last couple of weeks. Rates are finally starting to come down. And like I said, on a base rate, I'm in the mid fives to low fives. With a relationship, meaning that some banks like a relationship, meaning that if you've got money, instead of putting it all in the home, let's hang on to some of that money and move that over to the bank in a relationship, and I'm able to get better pricing. So I'm able to get rates, say, in the fours, which definitely benefits that client. And then they can invest that money any way they want. Instead of putting it in
Sure.
four walls, If I
Hmm.
stuck all my money in the four walls, I can't invest that. My money is sitting in four walls. So
Yeah.
this way I can use that money to let my money grow.
Yeah. Yeah. Now, I know that you have a family and you've been able to not only help your clients, but also in your four walls with raising your kids and all. What insights have you given them as far as wealth building? And what would you say similar, that share some wisdom with the audience?
Well, my sons are my oldest son is 43 and my youngest is 36. And my oldest son actually indirectly got in the business. He works in the appraisal side, so he really likes that side of the business. He's been doing it for over 20 years. He's very good at it.
Hmm.
He owns his own company on top of that. But he himself has owned a property, sold a property. He's looking right now to invest in a property outside of his existing market because it's very expensive where he lives. So he's
Okay.
looking at other areas to invest. In some markets, you can pick up a single family residence from $300,000 to $350,000.
Sure.
Where I live, like I said, in Orange County and here in California,
No
it's
way.
1.1 million, right?
Yeah.
So, but he's looking at, he knows buying a home is one, it's an investment. Two,
Mhm.
it gives him some sort of security as far as, as his investment, because again, it's real property.
Yeah.
It's not like you're buying a stock and you're hoping that whoever's running that company is doing their job.
Yeah.
You own that home. And so, it's a great investment, like I said. And so for young ones that are thinking about buying a home right now, I know it's scary right now with these higher interest rates. They're going to come down based on what I'm seeing, and again, almost 4 decades in this business, I've seen all the different trends throughout the years. The ultimate goal is they want to create home affordability, and so the
Yeah.
only way you're going to do that is by lowering interest rates. You can't do it any other way. And so when you lower interest rates, it creates affordability, and you're going to see more and more first-time home buyers be able to buy their first home.
Yeah, yeah. Well, that's important. And the salaries aren't matching, the cost of living and housing. So, um, what advice would you give to someone that comes to you and they're at that 1 million to 1.2 million, but then there's still other things you want to travel, you know, um, like you said, putting all your money into the house. So what can they do to prepare to, how do you get into a loan for 1.1 or $2 million?
Great question. So I do have one of my banks will go 90% loan to value, only 10% down, up to 2 million loan amount. And so again, there's some unique products with these banks.
Okay.
But really, if you're thinking about buying a home, is the first thing to do is make sure you have everything lined up. So let's start with credit, right? So, unfortunately, I see, many individuals are in debt with credit cards. You're paying high interest rates and so forth. It doesn't help your score, your credit score. That's first and foremost because banks do look at credit scores.
Yeah.
And banks are different, by the way. Some will go down to a 680 FICO score. Some won't go below a 720 FICO score. Now, in
Mm.
the Fannie Mae world, as I spoke about earlier with the conforming loans, they'll go down to a 620 FICO score and so forth. So, or even lower if they go FHA. But they really want to work on their credit, make sure they keep their debt low as it is, pay off as many credit cards as you can. You don't want to run balances up on your credit cards. And if you are going to have a balance on your credit card, try to keep it under 30%. So let's say your limit is $10,000. Don't get it above $3,000 because when you do, it's going to bring down your FICO score. That's first and foremost is credit. I see that a lot of times as an issue with
Okay.
many individuals.
Hmm.
Second thing is look at your savings, right? So you definitely show that you're saving money, you're putting money away. Now, there are programs again where if you let's say you had virtually no savings, family can help out, whether it's parents, grandparents, a brother, sister, whatever, uncle, aunt, whatever it may be, they can always gift you the down payment. So that's an option too for the down payment side of it. So you want to, again, you want to save as much money as you can, but you don't have to save 20% down to buy a property. So if you think, oh, I've got to save 20%. So let's call it $1 million sale. That's
Yeah.
$200,000. You don't. I mean, you can come in with even as little as 5% down under Fannie Mae, Freddie Mac on a high cost area like Orange County. So
Hmm.
you can get an over $1 million loan and only come in with 5% down. The rate is much higher, of course. So, but again, there's different opportunities as far as the down payment is concerned. And then last is your income. So, if you've got a job where you're a W-2 employee, lenders, what they do is they look at your gross income, not what you net. So if you gross, say, $150,000 a year, call it 15,000 a month as gross income, that's what they
Yeah.
qualify you as, that gross income, not what you take home. So it's a little different than if you're self-employed. It's a little different. So in self-employed income, you have your gross revenue, your gross income, then typically have your expenses, and you have what's called an AGI, your adjusted gross income.
Right.
That's what credit underwriters look at in qualifying. So if you're self-employed, most banks want to see 2 years self-employment history. And
Mm.
so it kind of gives you an idea. So basically, what I do is when I speak to a client, I'll go through their income, their assets, their credit, their overall situation, and then we figure out what's the best way to go.
Okay. Yeah. So it's very, like you said, the concierge program, it really caters to the client, and you're really designing with the understanding of where they're at financially. But if someone is like a year from now, they're getting lined up to be in the home market for their first purchase, it really start cleaning up your credit, making sure everything's on time and you can bring the balances down, build up your savings so you're prepared for rainy days and unforeseen events, which happens in life. But it's just
Absolutely.
being prepared. Opportunity for a 4% interest rate requires preparation.
And another thing to add too that some of these banks have, it's called a non-occupant co-borrower. So, for instance, I've got one right now, working with a client. It's a multi-million dollar property. The father is very, very wealthy, bought his child a home,
Mm,
and would like to get them established with credit and so forth. So what we're doing is what's called a non-occupant co-borrower. So the father in this instance can qualify on his own. Instead of him buying, he was thinking about buying an investment property for his child, and then adding them to the loan, whatever, and doing an investment loan. I said, no, you can do it as a primary residence because your child is the occupant. So they will be on the loan application and qualifying, but it's really their name, address, phone number, social security number, and date of birth and so forth. You don't
yeah.
even need their income. They don't even have to have income in essence. But if
Oh,
they do,
wow.
it's great. But the parent can actually qualify for the child. And also, believe it or not, it can go the other way. A child can qualify for their parents. We've seen it again too, where you've got a child that wants to take care of their parent and they want
Yeah.
to get them a home. So basically, they can buy a primary residence for their parent and go on the loan as a non-occupant co-borrower. I mean, they're not going to occupy that property; they're going to
Yeah.
qualify for that loan.
Okay. Non-occupant co-borrower.
Co-borrower, yes,
Okay. Now that's a loan type I haven't heard of. So that's fantastic. That's a
yeah,
great strategy. And
absolutely.
you could use that probably too when someone's going off to college. Could you use that where they're instead of renting for 4 years or after their freshman year, they can move out the dorm, you buy something, and then like a condo or a duplex or something. Would that qualify for that loan?
Absolutely. So, if you think of right now, let's call baby boomers, right? I'm a baby boomer, but think of baby boomers overall. Yeah. So, baby boomers, typically have whether it's assets, equity, things like that, and they're trying to help their kids out, whether it's a millennial or a Gen Z or whatever it may be, or a grandchild. They can help them out, whether it's the down payment, help them in qualifying, but absolutely. So, for instance, let's say someone's going away to school, and I've helped a client, exact same situation. Their child was going to school back east. I think it was South Carolina in this instance. And the property values there around 350, 400,000. And they were looking at, renting with a dorm, and they got into the cost, and literally they could buy a property for their
Yeah,
child, rent out the other rooms to some other students, generate income that way, and basically they got free rent. And
I
so, it's another opportunity where they could think about doing, especially in some areas where, like I said, the property values are $350,000.
sure.
It becomes, a little more advantageous to do that versus to pay for rent or a dorm or whatever it may cost in that situation.
Yeah, yeah, that's a really smart way to go about it. And again, it's just being prepared, thinking
Yes.
ahead. So planning is year round. A lot of times people think about their finances at the beginning of the year or around tax time, and then that's like January to April 15th, and then they forget about it till the next year. What do you think of that strategy?
I think any time is a great time to buy, be quite honest with you. So, yes, there are times when your CPA will tell you, you need to look at buying something right now. You're paying a lot in income taxes. So, a real estate is a great opportunity to write off, many different items and so forth you can write off. I know if they buy an investment property, you've got the Schedule E where they'll write it off and you've got depreciation and so forth. So,
Yeah.
it's a way to generate some income in that instance. But it really doesn't matter. I think overall is you're going to find any time of the year is a great time to buy. Now, mind you, sometimes in the year where, let's say December, for instance, in January and February, it's the slowest time in the industry, right?
Yeah.
It's typically the best time to buy because
Exactly.
when it's
Mhm.
slow, you don't
Mhm.
have as much competition. So think
Right.
about this, for instance, if rates continually drop as we're seeing right now, and
Mhm.
they start going from the sixes to the fives to the fours, there's a lot of pent up demand right now that's sitting on the sidelines right now, waiting for these rates to come down. And if you remember going back 2, 3 years ago, let's say 22 and 21 and back in 2020,
Yeah.
it was a feeding frenzy. It was an
Sure.
absolute feeding frenzy. I refinanced my home at 2.5% interest rate, right? And there were
Ooh.
many individuals out there that got rates in the twos and threes.
Right.
It was a bidding war. And that was the sad part is that, when the rates get very, very low, you got
Yeah.
all these individuals that have been waiting on the sidelines coming out, and next it becomes a feeding frenzy. Because in all honesty, we don't really have enough inventory right now. There's still a
Mhm.
shortage of inventory. Now it's better than it was a year ago, but in some areas it's really tight on inventory. So
Yeah.
if the rates get low, and you're gonna basically create this feeding frenzy. Now all of a sudden that home that you're looking to buy at 1 million or one whatever is now you're going to buy it at 1,100,000 or 1,150,000. You're going to buy it over market because again, is that you've got this pent up demand that's going to come to the market and want to buy a property. And right now in Southern Orange County where I live, 1 out of 3 homes that sells on the market sold over ask price, sold over the list price. 1 out of 3 right now with the rates where they're at right now.
That's crazy. But I agree 100%. That time between Thanksgiving and the end of January is a sweet spot for not having for the lowest amount of competition. So definitely keep that in mind. That's a great strategy to store away in your
Absolutely.
memory banks, right? Yeah. Well, I really appreciate you coming on today and sharing this valuable insights with the audience because these are the type of things that you don't hear in everyday conversation, but they're definitely game-changing information. So this is a way to really take some of the information and the gems here today and turn those into, you know, dollar bills and legacy, passive income. It's your creativity to make what you will of it. So thank you so much, Alan, for joining us today. We're going to have you back again and share some more gems with us.
Thank you for having me on. I really appreciate it.
Thank you for tuning in to Crown and Keys, where wealth meets wisdom and legacy is built with intention. If today's episode inspired you, don't keep it to yourself. Share it, subscribe, and leave a review. And if you're ready to take your wealth strategy to the next level, visit crownandkeyspodcast.com to align your finances with your future. Until next time, stay aligned, stay empowered, and keep building your legacy. Your keys are in your hand. See you soon.